They don't pay taxes the way you do. They don't sell what made them rich. 3 words explain everything. Buy, borrow, die. Say them once, say them again. Buy, borrow, die. Picture a person walking into a bank with a portfolio worth hundreds of millions and walking out with cash without selling a single share. That image feels impossible until you learn the rules. Once you know the rules, the image becomes ordinary. Stay with me until the end and you'll see exactly how the machine works, why it's legal, and why it keeps wealth concentrated for generations. Buy. The ultra-wealthy buy assets that appreciate, not cars, not gadgets, not short-term thrills. They buy stakes in companies, private businesses, commercial real estate, rare art, and other things that compound value quietly for years. That growth is called an unrealized gain, value that exists on paper but hasn't been converted into cash. If you never sell, the taxman never gets his cut. Most people think wealth is what's in the bank. The wealthy think wealth is what's on the balance sheet. They let the forest of gains grow quietly year after year while the rest of us cash out and get taxed. Hold that image, a forest of value growing silently, invisible to the tax ledger until someone chops a tree down. Borrow. Instead of selling, they borrow. They pledge those appreciating assets as collateral and take out loans. Loans are not income. You do not pay income tax on borrowed cash. So someone with 100 million in stock can borrow tens of millions, walk out with spendable cash, and still own the asset that keeps rising. That borrowed money funds yachts, deals, new companies, philanthropy, political influence, whatever they want, while the underlying fortune keeps compounding. The math is simple and brutal. If the asset grows faster than the loan interest, net worth still climbs. No sale, no capital gains tax, liquidity without taxation. Picture the same forest, but now the owner is living off the fruit without cutting down the trees. The fruit feeds a lifestyle, the trees keep growing. Die. The final move is the most powerful. When the owner dies, heirs often receive a step-up in basis, resetting the asset's tax basis to market value at death, and effectively erasing decades of unrealized gains for tax purposes. Bought at 10, worth 1,000, die, heirs inherit at 1,000. The $990 of gain vanishes from the tax ledger. That is how fortunes survive and become dynasties. That is how a family that started with one business becomes a multi-generation power. Imagine generations inheriting forests already mature with no tax bill for the growth that happened before. That reset is the final sweep that clears the ledger. Repeat the loop. Buy appreciating assets, borrow against them, let them compound, and pass them on tax light. Layer trusts, family offices, securities-based lines of credit, private bank facilities, intra-family loans, life insurance strategies, charitable vehicles, and carefully timed gifts to amplify the effect. Each legal piece alone looks ordinary. Together, they form a machine that turns paper into power. Use margin loans, pledge shares, create holding companies, and structure estates so timing and control favor preservation. It is not a single trick, it is a system built from many legal pieces that fit together. Think of it as an engine with many gears. Each gear is legal, each gear is ordinary, but together they produce extraordinary outcomes. This is legal, it is structural. Teams of lawyers, accountants, and bespoke lenders design the stack so rules that reward ownership and defer realization work in favor of capital, not labor. That is why headlines about billionaires paying little or no income tax explode. Their wealth is mostly unrealized, and their liquidity often comes from borrowing, not taxable income. The optics are shocking, but the mechanics are straightforward. The outrage is real because the rules create a different tax experience for capital owners than for wage earners. That difference is the story. Scale matters. Bigger portfolios secure cheaper credit and bespoke lending terms.
Private companies can be recapitalized, shares pledged, and complex debt structures created that ordinary investors cannot access. Family offices negotiate terms retail investors never see. That scale creates a feedback loop. More assets, better credit, more liquidity, more growth, more legacy. The system rewards scale, access, and sophistication. The bigger the balance sheet, the more powerful the loop becomes. The wealthy can borrow at lower rates, restructure debt, and access private credit that cushions shocks. That advantage compounds.
It is not risk-free. Market crashes can wipe out collateral value and trigger margin calls. Interest rate spikes can make borrowing expensive. Bad timing or poor leverage can destroy wealth. But the ultra-wealthy mitigate these risks with diversification, hedging, insurance, and access to emergency liquidity. They buy downside protection, hedge currency and interest exposure, and keep relationships with lenders who will extend or restructure credit when markets wobble. Risk exists, but it is managed. The difference is they can afford to manage it at scale. They can buy insurance against the very risks that would ruin smaller investors.
Now picture a brutal, simple example you can hold in your head. Someone buys a private company stake for $10 million. Over 20 years, it grows to $200 million. If they sold, capital gains tax would bite a huge chunk. Instead, they borrow against that stake, say $30 million, to fund living expenses, new investments, and philanthropy. The company keeps growing, the owner never realizes the gain. When they die, the heirs inherit the stake at market value, not the original $10 million. The tax on the entire lifetime of appreciation is effectively avoided. That is not a loophole. That is how the rules are written. The rules were designed for reasons: to encourage investment, to avoid forced sales, to enable philanthropy, but the combined effect is a pathway for wealth to grow and pass on with minimal tax friction. Why does this feel unfair? Because most of us pay taxes on income as it arrives. Paychecks, bonuses, sales. The ultra-wealthy defer or avoid those same taxes by keeping wealth unrealized and using debt as a tool. Headlines that scream, "Billionaire paid zero income tax this year," are often true in the narrow sense because taxable income was low, while borrowing provided liquidity. The nuance matters because it shapes what reforms would actually do. You can be outraged and still understand the mechanics. Understanding is the first step toward meaningful debate. Break the legal levers apart so you can see the gears. Unrealized gains are not taxed until realization. Loans are not income. The step-up in basis wipes out capital gains at death. Trusts and estate vehicles control timing and access. Charitable vehicles and life insurance can further shelter value. Each of these rules has a purpose in the tax code: encouraging investment, avoiding forced sales, enabling philanthropy. But together, they create a pathway for wealth to grow and pass on with minimal tax friction. That pathway is the reason dynasties form and why tax headlines keep exploding. When rules interact, outcomes can be surprising. That surprise is the engine of headlines. Here is the human truth behind the mechanics. This strategy is as much about control as it is about taxes. Control over liquidity, control over timing, control over legacy. When you can turn paper into cash without selling, you control when and how value is realized. When you can reset basis at death, you control what future generations inherit. That control concentrates power, influence, and options in ways that compound beyond money. Power begets access. Access begets better terms. Better terms beget more power. It is a cycle that feeds itself. If you want to use this knowledge, start with mindset. Think like an owner, not a consumer. Prioritize assets that can appreciate. Delay realization when possible. Use tax-efficient accounts and long-term holdings. Learn how securities-based lending works so you can access liquidity without selling. Understand basis,
gifting rules, and estate planning early. Small changes compound over decades. Hold longer. Use tax-deferred accounts. Structure gifts thoughtfully. Plan your legacy before it is urgent. These are not shortcuts to instant riches. They are disciplined choices that change outcomes over time.
Practical moves that matter. Hold investments longer to benefit from lower long-term capital gains rates where they apply. Use tax-deferred retirement accounts. Understand how basis changes with gifts and sales. Consider trusts and estate planning early. Learn how securities-based lending works so you can access liquidity without triggering taxable events. These steps shift the balance sheet over decades. They are the difference between a lifetime of incremental gains and a legacy that survives generations. If you care about fairness, engage in the policy conversation. Proposals to tax unrealized gains, limit step-up in basis, or tighten rules around related party loans and trusts are complex and have trade-offs. Taxing unrealized gains could force sales in illiquid markets and create valuation headaches. Limiting step-up could change how families transfer businesses and farms. The debate matters because the rules shape incentives and outcomes. The more people understand the mechanics, the better the public conversation will be. Knowledge is the first step toward change. Remember the 3 words. Repeat them until they land. Buy, borrow, die. Let them sit heavy. They explain why some people can live lavishly while paying little taxable income, why dynasties persist, and why tax reform conversations keep returning to the same battlegrounds. This is not a conspiracy. It is a blueprint written into law and amplified by capital. It rewards ownership, defers taxation, and privileges those with access to credit and advice. It creates a world where paper wealth funds lifestyles without triggering the same tax events that ordinary income does. If you want to change the outcome, change the rules, or learn to play them smarter. Build assets that appreciate. Use debt strategically. Plan your legacy early. Protect against downside. Never confuse liquidity with realization. Liquidity can come from loans. Realization comes from sales. Keep your eyes on the balance sheet, not just the bank account. Keep your mind on the long game, not the short thrill. Keep asking how rules shape outcomes and keep pushing for clarity and fairness. Buy, borrow, die. Say it one last time and let it echo. Buy, borrow, die. That phrase is the key to understanding how fortunes survive, how power concentrates, and why tax headlines keep exploding. Buy, borrow, die. Buy, borrow, die. Buy, borrow, die.